Hi, I'm Nussbaumer from Macrobeat.co.uk. Well, what a week it has been yet again, and it's just amazing what difference sort of 2 weeks make from the August time when we looked like the world is about to fall off a cliff to mid of September, where it seems as the world is just about fine again. Even though we know underneath it isn't really, but at least it starts to look like it again. What we had now the ECB is now out of the way from the two major central banks, the ECB this week with the Federal Reserve next week. The ECB indeed cut rates by 10 basis points, the first time they cut rates in like 3 years. And we got the QE too, so they start the QE again. 20 billion. And what it turns out to be that there was quite some division within the ECB. The market reaction, we come to that a little bit later on some of the slides, has been just remarkable and probably left more questions than it gives us answers. We obviously had some easing of the trade war. There's a lot of mumble going on between China and the US, some goodwill factors, which we come to that as well a little bit later on. And then we have the FOMC. But I would really like to start with my first slide, which is the sort of confidence data among US consumer. And there what we do see is that the entire saga of increase of tariffs, of the sort of trade war escalation, has really left a bitter taste in the US consumer. Why is that important? It is important because the US consumer was really what kept the US economy on track, while the manufacturing side has been deteriorating for quite some time. So if the consumer starts to roll over, that's when the Federal Reserve really should start to worry. On the second slide, we have the credit card spending. That's an index the Bank of America is running. What we see here is that the consumer or the spending dropped sharply now during August. We're going to have US retail sales this afternoon, whether this really feeds into it or not. But this would really be, if that builds a trend, this should be the next concern for the Federal Reserve. And, as I said, we come to that in a minute on the next week's FOMC. On the next slide, I just want to quickly show a little bit of a wrap-up of what happened yesterday. So when the ECB announced the start of QE, because the economists haven't been quite sure whether or not the ECB will already restart QE now, or if they wait until Lagarde is taking over from Draghi. We tested this 109, 20, 30 area again. This is the year's low, which we saw during August. And then, as you can see, a very sharp rally where the market just seems to have sort of figured out that maybe the ECB is indeed coming to the end of the road, and maybe that was the sort of last event from the ECB, which is a little bit concerning in that regard if the market really thinks that the ECB doesn't have any bullets left. On the next chart, what we see is the same reaction in yields. So we had a drop on the German 10-year yields on the announcement of the QE from the ECB. And then we had a tremendous move, which some call a sort of 7 sigma move in the 2-year yields, which is just really a concern for the ECB. So more or less what they done yesterday just had no impact whatsoever. On the last chart, we just have a quick look at the dollar index. Here we just see the sharp drop in the euro yesterday has now made another high at 99 in the dollar index. But this is the third time we had a sharp rally in the dollar, and we can't really hold it, and we had an immediate setback. So the dollar continues to be in that sort of still holding in well, but really making zero ground in the last few months. And I still expect the dollar to eventually start to top out. In terms of next week, the FOMC 25 basis points is pretty much priced in, which is a real challenge for the Federal Reserve, given we are near all-time highs in equities. The trade war seems to be de-escalating somewhat, but the Fed has to deliver 25 basis points. What will be key today is US retail sales. If you really get a shocking number from retail sales, the Fed might actually start to realize that what we see in the global economy, the weakness in the global economy, might finally start to hit home. And even though stocks are near the all-time highs, we might actually start to get an easing cycle from the Fed. But more on that next week. That's me, Nussbaumer, Macrobeat.co.uk. Thanks very much, and bye-bye.